Hello, everyone, and thank you for joining us for today's webinar on gift acceptance policies and procedures for nonprofits. First, I'd like to go over a few housekeeping items. If you're listening to a recording, this information will not apply. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a chat box that you can use to enter those questions. Just type your questions in and click Submit. Next, to ensure good audio quality, please ensure you have selected the right setting. If you're using a telephone, please click on the phone call audio option. If you're listening through your computer, then please click on this computer audio option. Now, I'd like to present a quick review of California CE requirements. To qualify for California CE, you must use a personal computer, no smartphones, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar, actively respond to at least 75% of the polling questions there are 4, which means you need to answer 3, and complete the evaluation survey at the end of the webinar. Now, a quick intro to our two presenters. First up, we have Renee Ordino, partner and audit partner with the firm in Los Angeles. She brings more than 25 years of experience in public accounting and industry. She has served as the CFO of a nonprofit organization and brings an entrepreneurial approach to her work. In the nonprofit sector, her accounting expertise extends to income tax matters pertaining to unrelated business income and non-recurring business transactions. Next, we have David Wheeler-Newman, JD and partner with MSK. He advises nonprofit and charitable organizations on matters concerning governance, tax exemption, and charitable gift planning programs. He represents foundations, donors, and charities in negotiation and drafting of gift agreements to establish endowments, construct facilities, and funding programs. He has also been awarded numerous awards over the last few years, including the Leading Lawyers in Non-for-Profit and the 2015 Los Angeles Nonprofit Charities Lawyer of the Year Award. Next are learning objectives for those here looking for CE. During today's webinar, participants will review the difference between board-level gift acceptance policies and operational procedures, identify best practices for developing an effective policy, and delegating authority to senior staff. Finally, we'll explain how and when to effectively record the different types of gifts under the new accounting standards. Lastly, a quick overview of our presentation. We'll review policy statements versus procedures. What are the differences? Creating policy procedures. What are the general guidelines, specific issues, and specific assets needed for your nonprofit? And finally, we'll look at accounting for different types of gifts, including non-cash contributions. David?
Documents that I've reviewed on behalf of clients have been rendered ineffective by the failure of the people who prepared them to make this distinction. So policies have a distinct purpose to encourage gifts that are consistent with the values and objectives of your organization. We want to make sure that we maximize staff and other resources, anticipate issues that are going to come up in the process of accepting gifts to the organization. And in putting the policies together, our chances of a good outcome are going to be best when we focus on these purposes that we're trying to achieve. So what should those purposes be? The best way, I think, to think of policies are at the 30,000-foot level, that a statement of policy is a statement by the governing body of the official policy of the organization. These policies should be broad and brief. That's because the governing body's responsibility is oversight. The governing body is not responsible for operational details. In the case of policies, that short really is sweet.
So David, should boards of directors get involved with decisions like what types of assets that an organization might accept?
I think only at the broadest possible level. As we'll see in a moment, there are some things from a policy standpoint that may be inconsistent with the values of the organization. For example, It may be accepting gifts of stock and tobacco companies or energy companies that may be inconsistent with the program objectives and core values of an organization. So only at the most at the highest level of that relationship to the core values, I'd say, should the board be involved in the types of gifts that would be accepted. Otherwise, it's too detailed, too ground level. On the other hand, the procedures should be much more granular than policies. The purpose of procedures should be to lay out just step by step the steps that should be followed in accepting gifts, in deciding what gifts may be accepted and the procedures to be followed. There should be clear rules to be observed and approvals that are required. In other words, the procedures should effectively and efficiently implement those higher level broad procedures, the broad level policies, I should say. I think the best way to think of gift acceptance procedures is more like a user's manual, where you have a broad statement of policy in the board level statement of policy, and then at the implementation level there's a user's manual made up of step-by-step procedures with rules for allocating responsibility and approvals. The procedures can serve additional purposes as well. For example, procedures can be used as in donor relations, and so if there is a donor that everyone likes that wants to give a particular type of asset that is something that for a variety of reasons we just don't want to accept, either that it's going to require too many staff resources to manage and sell that asset, or it's going to be difficult for us to value for accounting purposes. Rather than being the development officer or program officer for the nonprofit that's telling the donor that we just can't do that, instead you can point to our procedures saying, we'd like to work with you on this, but it's something that we've got these rules that we need to follow. The procedures can also serve a risk management function, so that this, by having the detailed user's manual, it reduces the chance of inadvertently accepting something that you later wish that you hadn't accepted, either from reputational risk or actual liability, to have procedures that you go through to make sure that that doesn't happen. And finally, the detailed procedures can serve an educational function. So by educating the staff and outside advisors who may be bringing gifts to the organization, everyone can be aware of what's going to be acceptable, right, in terms of gifts that are brought to the organization, and what may not make it through the process. That's very helpful for your board as well, since the board is often your frontline ambassador for interfacing with potential donors and advisors in the community, so that they're not promoting potential gifts that would be inconsistent with what's going to be acceptable to the organization.
We didn't list it here, David, but having these written policies and procedures and communicating them effectively to all those different constituencies within an organization, I think is a really important way to support the organization's internal control around contributions, which helps, manage the finance function effectively and ensure that your audits go smoothly.
That's a very good point, that those internal controls, as they apply to gift acceptance, can be embedded right there in your detailed procedures. That's a good point. So if we're talking about the purposes to be served by the two types of documents, the policy and the procedure document, and I would suggest that they be in separate documents. You'll find specimens or samples that are actually included in your written materials. In looking at the purposes to be served by each, what actually belongs in a statement of policy, what we would like to see in it, is the official policies of the organization when it comes to gift acceptance that are stated as simply as possible. These should be broad statements. As I mentioned earlier, there may be categories of assets that we simply won't consider because they're inconsistent with the purposes of the organization or its core beliefs. There may be staff resource issues that are where we won't consider certain types of gifts as a matter of policy because we want to devote our staff resources elsewhere. But I think the important thing is that what belongs in the statement of policy is something that is simply stated and beyond that simple statement delegates to the appropriate staff person, a single person identified by their title, for example, Vice President of Advancement or Director of Development. There should be a single person who has both the authority and the responsibility to implement those procedures at the staff level.
So part of that implementation, of course, is going to involve how these are recorded and presented in an organization's financial statements. I know we have a lot of CFOs and controllers with us today who would be probably people listed in those procedures. And you may all be wondering how the new accounting standard that's just been released for not-for-profit organizations might impact things like contributions and specifically donor restrictions. We're not going to go into that in depth here. We've got some other webinars that we'll be scheduling, so keep an eye out for that will take us deeper in. But we thought you might be interested in seeing how the donor restrictions will be changing on the face of the financial statements. You may have heard that donor restrictions will be combined into one category from the two, temporarily restricted and permanent restricted. But for best practices, there really needs to be the appropriate disclosure about what the donor restrictions are. So we've given some examples here. It's not necessarily prescribed. It's going to depend upon an individual organization and what they need to disclose. But here's an example of things that include with donor restrictions. Perpetual would be the equivalent of what's currently permanently restricted. Items that are purpose restricted, and then perhaps a separate category for gifts that are time restricted. And on the without donor restriction side, there's more opportunity to communicate there with your donors, whether you've got an endowment that's been set up by the board, you've got a liquidity reserve, and whether or not you have just plain undesignated funds, which most organizations would certainly have. And you can see that there might need to be board involvement and board policies that are addressed as the new standard is implemented.
So Renee, are these new standards going to make presentation simpler for the reader or more difficult to understand?
I think ultimately it will actually provide a lot more information to the readers of the financial statements. It might be a little bit more difficult for accounting teams to come up with the initial disclosures, but I think ultimately it will make much more sense to people reading an audited financial statement about what those restrictions on net assets really mean.
Well, we've talked about the separation of policies and procedures, and if I hadn't made the point before, let me make it one more time, that the statement of policies that is adopted by your board should be something that's short and sweet and a broad statement of policy with a delegation of authority down to the staff level where procedures are put together and implemented. So what should be in those procedures? I think the best way to think of the procedures, again, is like a user's manual that tries to anticipate the types of gifts that may be brought to the organization by prospective donors and how we're going to deal with each type of gift and the issues that those gifts might present. So, for example, there are some routine issues that are going to come up over and over again that should be covered with some specificity in the procedures. Renee mentioned donor-imposed restrictions as part of the new accounting standards, and you'll want to not only cover those in the procedures, but have those that coverage well integrated with the finance office in terms of how they will be taken into account on financial statements. The procedures should cover what documents and under what circumstances will require review of legal counsel. And so some documentation may be so standard or standardized because you've been given form documents by counsel that no further review is required, whereas there may be other documents or deviations from your standard forms that will require review by counsel, and the procedure should be specific for each instance so that there's nothing that falls through the gaps or that you're not overutilizing an expensive resource like legal review. The procedures should cover valuation of non-cash gifts, because any gift that comes in that is not cash is going to need to be valued by the organization. And finally, the procedures should have detailed rules for communication between departments in the organization, just to make sure that there are no surprises after a gift is accepted when another department then learns about it.
Yeah, I think that's so important. It's typically going to fall to the finance team to determine the valuation or work with outside experts if that's needed. A lot of times we see instances where a pledge has been made and the accounting group may not even be aware of that. And then you've got a misstatement in the financial statements because the accounting group didn't know that there was a pledge that needed to be recorded. So making sure that there's great communication between the development team and the finance team is really imperative.
So the procedures should cover the routine issues that come up over and over again. What else should be in the procedures? Well, there are various types of gift vehicles that may be involved in a prospective gift. And I think the next thing that the procedures should cover are standards for those various gift vehicles. For example, if the organization will encourage gifts, charitable remainder trusts, the procedures may cover the circumstances under which the organization would consider serving as trustee of the charitable remainder trust. Or the procedure may be that as a rule, the organization will not serve as trustee for various reasons and may have instead a preferred provider relationship with a bank or trust company, but that should be specified in the procedures.
David, what should an organization consider in determining whether they have the capacity to serve as a trustee?
That's a very good question, Renee, because it's not a simple responsive, it's not a simple reflexive response when asked to serve as trustee. I think the development team working with the donor, they want to do two things. First, they want to do everything the donor would like the organization to do. They want to keep the donor happy. And they would like to remain as close as possible to the donor, and what better way to remain close to the donor than to be serving as trustee of their trust. However, there's a lot involved with trusteeship, including administration of the trust, tax compliance, making sure the checks go out on time, and investing trust assets in a prudent manner. And the organization needs to think through whether it has the resources to take on that type of responsibility. In my view, I think for smaller organizations, it's probably not the best path. Instead, something like a preferred provider relationship with a bank or trust company and perhaps looking to grow its CRT, Charitable Remainder Trust, program up to a point in the future where it would have the resources and the critical mass of trust assets to then take over trusteeship. But it's not an easy question. In other gift vehicles that the organization may be asked to consider include gift annuity rates, and because the annuity obligation to the annuitant in a gift annuity is an obligation of the charity, a real liability, the rates that are offered is a very important question there. There's a group, the American Council on Gift Annuities, that proposes, based on actuaries that they retain, recommended rates for charities to follow. And many charities, but not all charities, that issue gift annuities follow those ACGA rates. But then the question is, first, do we belong, similar to the trusteeship question, do we belong in this business of taking on the liability of issuing annuities to our donors? And if so, what rates are we going to use to establish that liability? Another category of issues that needs to be covered in some detail on your procedures is specific types of assets that may be offered as gifts to the organizations. And so the staff needs to think through each category of asset and to have rules for dealing with them. So assets, for example, what rules would be followed in accepting gifts of real estate if we are going to encourage gifts of real estate at all, rules for accepting gifts of closely held stock, and other categories of assets other than cash, of course, which is always easy to accept. What would be the rules that we follow in evaluating and deciding whether or not we're going to accept these various types of assets. And I think the most important thing in each asset category, and I think this is true throughout the procedures in general, is to assign both authority and responsibility. So if there are deviations from the rules, if there's special permission that's required, to be able to look to one individual by title who has that authority and who has the responsibility for making the decision.
Yeah, I think both of these categories that you've listed here can be problematic for organizations. You know, we've had clients who receive closely held stock, but they may not practically ever be able to dispose of the stock. So that's something that becomes very difficult to value. Is there a value? And real estate has its own hazards. I mean, it can be wonderful to receive a gift of real estate, but you know, I'm sure you've seen situations where perhaps the real estate's encumbered with debt or other restrictions. Maybe there's environmental issues that need to be considered before accepting real estate gift.
There are these asset categories, other than stock and marketable securities, each carries with them unique issues, perhaps requiring unique expertise to evaluate and turn that asset into cash. And in my experience, without thinking through the procedures, those issues are often underestimated until it's too late, and suddenly you've got a lot of staff time consumed with managing a piece of real estate or trying to figure out how to turn closely held stock into cash after it's already been accepted from the donor. We've talked about what belongs in a statement of policy and what belongs in your procedures. What doesn't belong in either place? What doesn't belong either place is a lengthy description of various types of gift vehicles and a discussion of tax planning and consequences. I think it's natural for all of us to want to demonstrate that we know our stuff, that we have learned our subject matter area, and the way that we demonstrate that is writing a long document showing everything that we know. But those long expositions definitely don't belong in your gift acceptance policy for the board, because they need something that is short, broad, and to the point. And even in procedures, that people can get bogged down in all the exposition when what they need is step-by-step checklists, rules of the road, and clear assignment of responsibility and authority.
Absolutely, and I think there's a danger too, as a not-for-profit organization, you really don't want to be in a position where you're inadvertently giving tax advice to your donors. You know, that's really the responsibility of their advisors. I think next up we have a polling question.
Thanks, Renee. So we're here with our first polling question. We'll launch it here in just a moment. Question is, which of the following does your nonprofit have in place? A, a policy statement, B, a procedure, C, both a policy statement and a procedure, D, neither, or E, not sure. And as a reminder for those of you who have some audio issues, I think we're fixing them on our end, but if you have any problems, do let us know. Please do answer the polling questions on the screen. And for those of you who are asking for
Okay, I think we're weirdly having a technical difficulty with our polling question. Yeah, Debbie, I think we're going to have to move on. It seems like the polling question is inadvertently closed.
Yep, that's fine, Renee. So we'll skip this one and keep moving. We're fine for CE right now, so we'll fix those technical difficulties on our end and keep going. So next section.
So maybe we can just say that everybody got that question right. So now that we know what we're talking about, the purposes to be served by policies and procedures, how do we actually go about reducing them to writing and then getting them approved? Well, the first step is to start with policies. And in putting together a statement of policy, I think the important first step is to look at where you want to end up with your last step. In other words, to anticipate the format of the finished product, because many organizations have a standard template for their board policies, and you don't want to be preparing something that doesn't fit into that template. And so the first step is to anticipate what format your policy will be adopted by the board. I think as part of the first steps, you want to dive into the organization's history, to look at files and records, memos, correspondence and documents from the past that may have come up in gift acceptance situations, because the ad hoc policy of the organization, ad hoc gift acceptance policy, may actually be embedded in a memo that was prepared by your predecessor's predecessor. And so you want to make sure that you know what may have been done inadvertently as an ad hoc policy, and also to make sure that the new policy that you adopt explicitly supersedes those antecedents, because you want clarity, especially when it comes to delegation of authority and the assignment of responsibility. Like a lot of things, you need to really start by doing your research. And a place to start is looking at professional commentary. There's a fair amount of it out there. People making suggestions on what should go into gift acceptance policies and procedure documents. And I think it's very important for the person who's taking the lead on this to be conversant in that commentary, simply because the people that you're presenting these documents to may already be familiar with that commentary. The one thing I would caution on with all that you want to read and the background that you need to get is that one size does not fit all here, and the important thing is to come up with something eventually that's tailored to your organization. But in continuing that research, part of your research may be to see what other organizations have done, and there are a lot of statements of policy that are posted online, of gift acceptance policies. And you might be able to get them from other organizations in your community. In reviewing those organizations, I think their statements, their policy statements can be used as a checklist to make sure that you've covered everything, either in policies or in procedures. But I would caution you not to use those statements of policy as your first draft. In my experience reviewing dozens and dozens of these, the cut and paste approach, it leads to the worst results, where you have things that don't apply to your organization, that may be redundant or have gaps in them, and so although you can learn a lot by looking to see what other organizations have done, don't just copy it and say that that's the first draft of your own statement of policy.
What do you think, David, about combining a gift acceptance policy with other related issues like a spending policy? Are these things can be put together, or is it better to separate them?
I think it's better to separate them, because for the policies themselves, they address separate issues. The spending policy is essentially a finance function, whereas the gift acceptance policy may serve a broader function in terms of maintaining consistency with the purposes, the goals and objectives of the organization, and risk management. So I think it's actually better to keep them separate if possible. Well, whatever we prepare in the way of a statement of policy, ultimately you're going to need to get it approved by your board of directors. And how do you go about that? I think the important concept here is what you might think of as 3 bites at the apple, that you want to avoid unpredictable results that can happen when the board is surprised by something. And so I think by doing it in 3 steps, you can avoid those unfortunate surprises. That the first step at the beginning of the project is to inform the board of the project that's going to be undertaken, and to summarize the objectives that you're trying to achieve in the gift acceptance policy. The second board meeting or committee meeting would be a midway progress report to say how the project is developing and how things are coming together, maybe a little preview of what the policy is going to look like, so that by the time the third board meeting or committee meeting, where you are hoping for a vote to approve the statement of policy, you want the whole process, the concepts underlying the policy, to be so familiar to the body that there are no surprises, and it seems very familiar to them. One tip from someone who's been through this many times is, when you're sitting in front of the final board meeting or committee meeting asking for approval, you'd like to have them looking at slides with bullet points describing the policy rather than the document itself. That you don't want people sitting around the table wordsmithing a document. Instead, you'd like to have them focusing on, of course you're going to send them the document in the board packet or have it available for committee members, but the important thing, I think, is it's helpful if you're looking at bullet points rather than wordsmithing.
Great, thanks, David. Now I think we're trying another poll question. Hopefully it'll work this time.
Hi, everyone. All right, let's see if this one works. So, second polling question, make sure you answer this one. When it comes to policy statements and procedures, does the phrase one size fits all apply? A, true, B, false, or C, not sure. The screen should be working this time, so make sure you do click the radial buttons A, B, or C to submit your answers. And for those of you, I know we had some issues before, again, slides will be going out after the webinar along with a recording of today's presentation. I know it's been a little hit or miss today, so thanks for hanging with us. And we'll close the polls here. Make sure you submit those answers in 3, 2, and 1. And it looks like as they pop up, Renee and David, about 99% said false. So good job, team.
Good group. Let's look at some specific issues that need to be addressed in your gift acceptance policies. I think that one of the important issues involves restricted gifts. And when it comes to gifts that are going to be restricted by the donor, it's important to recognize that donors have legitimate interest in gift restrictions. There may be something near and dear to their hearts that they want to make sure that this gift is used for. But it's important that those restrictions are workable for the organization itself. And so you want to build in as much flexibility as possible into how gift restrictions are dealt with. And one way to do that is to have a variance power that is in your gift agreement so that on the occurrence of some future event, the restriction can be loosened and the gift redirected to something that is more valuable for the organization. And I think the key point here is that flexibility, the variance power in the gift agreement, is a matter of policy rather than negotiated on a case-by-case basis. You're going to get more consistent results, and it works better from a donor relations standpoint.
I think that's excellent advice, David. I personally have had a number of clients over the years that frankly have been around for decades, some even 100 years. And the terms under which gifts were accepted in the past may not really fit their current situation. And so having some sort of variance built into it, it might make it a little bit more complicated in figuring out what the donor restriction is. But if there's some way that the board has the right to make changes after a suitable period of time and, when they've honored the donor's intent, I think that would be a fantastic reason to put together a gift acceptance policy.
Well, there's one area of a policy and procedure that can cause a lot of angst and is very important to donors, and that is, how is their gift going to be recognized by the organization? And I think that this is an area that you just have to have well organized before gifts are solicited, so that you're able to know in advance, for this category of gift, this is how the person would be recognized. And so, for example, you should have a ready-made schedule of naming opportunities. If you're doing fundraising to build a new facility, typically you're going to want to offer major donors the naming opportunities for all or part of that facility. Have it organized in advance so that you know at what level of giving what type of recognition is offered. Also for different categories of donors. For example, a legacy society may be the recognition for planned giving or bequest donors. By having that laid out in advance, it's going to avoid confusion and inconsistent results, and as well as perhaps difficult negotiations with a donor. I think that may bring us to another polling question.
Wow, there's a lot. Have to get people their CPE though, right?
We do indeed. All right. Second official polling question. Organizations cannot accept gifts that require a deviation from core values and objectives. Is this A, true, B, false, or C, not sure? Make sure you select one of the buttons on the screen. Again, A, true, B, false, or C, not sure. And for those of you asking, again, I will be sending out a copy of the slides and a recording of the webinar following our presentation today. We'll let everyone enter their question or enter their answers. Also enter your questions if you have them. We'll close the polls here in 3, 2, and 1. And it looks like we're pretty split on this one, so maybe some clarification, David.
Yeah, I think, you know, can you accept something that deviates from your core value? I suppose. Should you?
Well, I think that is clearly a policy question, and so for the core value may be something you just cannot go beyond, no matter the size of the gift. And so thinking of an environmental organization, if they're being offered a major gift from an oil company, it may be that this is so antithetical to their core values that it would be problematic for their membership and for other donors. And so I think that accepting something that is not consistent with core values is something that would probably rarely happen, assuming that those values really do go to the core of the organization.
And that's the point of having this policy, right?
Exactly,
so that
right.
You've defined this. Legally, you may have the right to accept those gifts.
Yes.
Policy-wise, you're restricting
It may
yourself.
be a bad idea. Yeah, good point. Well, turning to the detailed procedures, the procedures should address specific types of gift assets, as we've mentioned, and I think the best way to approach this is having step-by-step the rules that are observed for each category of assets. And so, for example, evaluating how do we take a non-cash, non-marketable security asset to liquidity? How do we turn this closely held stock into cash, and how long is that going to take? The guidelines should also say the types of assets that we won't accept. For example, there may be that the staff just doesn't have the ability to deal with tangible personal property like artwork or automobiles, and so there may be black and white rules in the procedures that we will not accept these 3 categories of assets. And I think the important thing, again, is this assignment of authority and responsibility. If someone comes and says, yeah, I know you don't normally accept artwork, but this painting's worth $5 million, and you can sell it in 3 weeks at Sotheby's, there has to be someone who has the authority to deviate from that general rule and accept responsibility for making that judgment call. The procedures should also cover a variety of issues that typically come up in organizations that have planned giving programs. So, for example, I mentioned earlier trusteeship, and Renee had explored that a little bit in terms of issues that an organization needs to consider before it takes on trusteeship, but that needs to be laid out in your procedures along with are we going to issue charitable gift annuities? Are we going to partner with a community foundation or other issuer to issue them on our behalf? And if so, what standards would be applied? But I think the more granular that you can have checklists, flowcharts, step-by-step, assignment of responsibility by the name of the officer, by position that makes those decisions, the more specific you can be in the procedures, the better.
Great. So I think we're going to spend just a few minutes talking about some of the accounting issues. This webinar is really, we've intended to focus on the policy. But again, since we know many of you are CFOs or controllers and may have questions about how you might account for some of these more unusual arrangements. We'll quickly go through this and hopefully have a little bit of time at the end if people have questions. A couple of things we might cover just because they're a little bit more unusual than recording cash or a pledge is tangible personal property that's used in operations of the organization, split interest agreements, and so those are the charitable remainder trusts and other types of beneficial interests that we've been touching on. Use of long-lived assets, which is similar to a lease type arrangement, and then possibly the bargain purchase option. So revenue recognition with respect to tangible personal property. Some organizations are reluctant to recognize non-cash contributions and may not have good systems in place for being able to do that. But why should you? Well, first, it actually provides a lot more information about an organization's actual support and their costs of providing services. Doing so allows for more comparability between similar organizations that have different sources of support. So one organization that receives, significant amounts of, let's say, food contributions might look very different from another organization that provides meals as part of its program but has to purchase. By recording the value of the gifts in kind, they're going to be more comparable in how they look. And maybe the most important for me as an auditor is that GAAP actually does require that you record non-cash contributions under certain circumstances. When should you not? Well, first would be that goods are not in a condition that allows for their use. And that ties it back into the gift acceptance policy. Why accept gifts that aren't in a condition that they can be used? But sometimes you do, and when that happens, you need to be able to dispose of them and not record them as revenue. You might also be an organization that receives a pass-through gift that's for the benefit of another organization. In that instance, it's something known as an agency transaction, and there's no revenue to the organization that receives it from the donor if the donor specifically says that it must be passed through to another organization and the intermediate organization has no variance power. It would just be recorded as a liability until it's passed on to the ultimate recipient. And then finally, there may be some instances where the value of the gift is just so difficult to determine that it simply can't be recognized. Those should be fairly rare situations, but they may happen. So what about the split interest agreements? We've talked about those a number of times. There's a lot of complexities here, and this is just going to cover a few brief things. But the first question is going to be, is the split interest agreement, as the charitable remainder trust, we'll use an example, is that revocable or irrevocable? Has the donor made a revocable gift? Frequently, it is irrevocable once the donor has made the gift, but not always. And if it is still revocable, it's a contingent gift, and so there's no revenue at that point. Commonly, a gift may be irrevocable to the charitable remainder trust, but the ultimate beneficiary could still be changed within the trust. And if so, if you're listed as the beneficiary, but the donor or someone else still has the power to change the beneficiary within the trust, then that makes it still contingent and not ready for revenue recognition. There's different treatments and whether the asset is actually held by the not-for-profit or by a third party. David talked about how for most organizations it's probably better to get a third party involved unless you're quite large. If that's the case, then you're going to be recording the gift at its net fair value. And fair value is something that might involve actuarial assumptions, and so that's another reason why you might not want to take on those responsibilities yourself due to the complexity of the valuation. So there's many things that need to be considered in valuing and recording split interest agreements, and this is something that you may want to involve your outside CPA or other advisors before you've accepted one, perhaps when you're even setting up a policy of how you might accept charitable remainder trusts and other split interest agreements. Real quickly on contributions of long-lived assets, generally speaking, we're talking about real estate. Currently under GAAP, there's two different alternatives. One is to recognize it all as unrestricted in the first year of the gift, and then depreciation expense is incurred over the useful life of the asset. The second and less common option is to treat the gift as a time restriction and then release the restriction annually using the depreciation expense, basically. The new accounting pronouncement that's just been released but is not yet effective is going to actually eliminate that second option. Probably won't impact most organizations. Most that I see use the first option, but some of them do use the second. Again, with real estate, you're going to have to consider the fair value of the real estate, whether or not there's limitations on use, whether or not you're going to accept real estate that has debt on it, and if so, how you're recording that. And then the final real estate related item we thought we would talk about is occasionally there will be a bargain purchase situation in which a property holder agrees to sell to a not-for-profit organization but at a much reduced price. And first of all, you have to make sure that isn't just the normal negotiation, and that the fair value really is what the ultimately negotiated price is. But if it's true that the seller is willing to make a partial contribution to an organization, as in this example where the value of the land is $3 million, but a resort agrees to accept only $500,000. The difference between those two amounts would be a contribution to the organization. So those are some examples of how your gift acceptance policy might flow through into your actual financial statements. I think we're at our last polling question, and then we're probably getting a little close to time, but I think David and I are both willing to stick around a little bit longer for anyone who wants to submit questions.
Sounds good. Yeah, we can probably handle at least one question at the end just to make sure everybody stays on the line long enough for their CE. Final question is, does your organization have split interest agreements? A, yes, and we agree to administer and hold assets. B, yes, but the assets are held by third parties. C, no, we do not have split interest agreements, or D, not sure. And if you do have any lingering questions, do submit them via the chat box. If you're trying to answer the polling question, do make sure you check a box on the screen. Do not submit them via the questions box, as the software should be working right now. So again, any last minute questions, do submit them in the question box. Please answer the polling question. We'll close the poll here in 3, 2, and 1. And it looks like, David and Renee, about 50% say they don't have split interest agreements.
So maybe they should contact David and figure out how they might, incorporate that as part of their planned giving program.
Either that or have a much simpler set of procedures. Well, we've talked about how to develop effective gift acceptance policies for the board of directors to adopt and procedures for the staff to implement those policies. And one important thing to keep in mind that I'd like to leave you with is that these are living documents. Don't put these on the shelf and just forget about them. Emphasize to stakeholders that they need to be reviewed and updated periodically in order to remain effective. One opportunity to do that is when you're launching a major fundraising initiative like a campaign.
Great point. Thank you, David. I also wanted to mention, I think there may end up being a lot of specific questions about accounting issues, and maybe particularly on how the new accounting standard might impact gift reporting or other things in the not-for-profit sector. For those of you in Southern California, Armanino will be hosting a live event actually on November 29th. It will be a lunch in downtown, and we'll be covering a number of items that are going to impact organizations through the new accounting standards. We're also setting up webinars related to the new standards, so we'll notify you all as soon as those dates are set.
All right. Thanks, Renee and David. So quick recap of what we've covered today. We've reviewed the differences between board-level gift acceptance policies and operational procedures. We've identified best practices for establishing an effective gift acceptance policy, and we've covered certain considerations in properly accounting for different types of gifts. We've got about 1 minute remaining. So if we've got one question, I think a big question that's come up a lot, David and Renee, is are there some templates, are there some samples maybe that we can send some folks following the webinar, and so maybe I can circle with you guys following this and send that out with the recording and the slides. That's been a consistent question throughout the webinar.
Well, when I first started practicing law, I was told by my senior partner, David, you can speak all you want, but whatever you do, don't give away the firm's form documents. I've broken that rule for this topic because it's near and dear to my heart. Actually included with your written materials is our template for what a policy statement should look like and a suggestion of what procedures should look like. So yes, we can provide samples of what I consider to be effective policy statements and statements of procedures.
Perfect. So we are at time. We have had some other questions come in, and again, I will make sure that I circle with David and Renee to follow up with you individually on your very specific questions that you have related to organizations. We'll get their contact info up there. If not, again, it will be in the email that I send you following the webinar. Thank you for hanging with us. We appreciate you coming through the technological difficulties we had today. Not the norm, so thank you, and we hope to see you at a future webinar. Have a great day.